Hello and welcome to Econo Day Unplugged on Wednesday, the 6th of May 2020. Mark Pender is stateside, Brian Jackson's in Sydney, and I'm Jeremy Hawkins here in London. Financial markets remain predictably volatile as the rising onslaught of really bad economic data is parried by hopes that the worst of the COVID-19 crisis may be behind us. In recent days, sentiment has not been helped by an escalation in the coronavirus blame game between the US and China, which has prompted fresh concerns about the longer-term prospects for global trade. And a new spat between North and South Korea at the weekend was something that investors could certainly have done without. In terms of the economic data, last week gave us an early taste of the virus effects on overall economic performance by sizable declines in first quarter GDP out of the US and in particular the Eurozone. But as bad as they were, the second quarter will of course be much, much worse as lockdowns more fully constrict both demand and supply. So investors are still looking to China for some light at the end of the tunnel, which inevitably puts the spotlight on Brian. So, Mr. Jackson, the virus numbers would appear to be doing, well, I guess what they're supposed to be doing. But how's the economy holding up?
Well, yeah, I think across the region, what we're seeing is that the numbers are very weak, but broadly in line with what you would expect to see in these circumstances. As we know, many economies in the Asia-Pacific region rely very heavily on global demand to drive their economic growth rather than domestic demand. And, this has clearly weakened significantly. And in addition, what we've seen is that governments across the region have to varying degrees put in place social restrictions, business restrictions to try and curb the spread of the disease. So when you add those two things together, it's not surprising that you're going to see just huge swathes of the Asian economy shut down. And so now we're seeing that in the numbers. We're right. We're nearly at the end of this month's cycle of PMI survey numbers, and they are definitely grim, and in some cases quite remarkably so.
In terms of China, we've had the first quarter GDP numbers. Are there any kind of expectations for what the second quarter might look like yet?
No, not really. I mean, that's still quite a bit down the track. But just looking at the what we do have for the current quarter so far, it's mainly the PMI numbers, and they are just showing some signs of stabilisation, but at a very weak level. And again, that's consistent with sort of the anecdotal reports that the factories are starting are back in swing, but not really getting anywhere near back to where they were before the crisis struck. And now I think what we are seeing more clearly is that there's sort of like a rolling impact of this crisis sort of going across the rest of the region now. And so the big hit to China happened very quickly, and now we're seeing the hit in other parts of Asia.
Hong Kong then, just sort of segueing off from what you're talking about, the China spillover effect there. I mean, clearly Hong Kong's had a lot of problems for a lot of time now. Originally, we have domestic violence and disputes and all this sort of thing. Now being hit with the virus, we had a big decline in first quarter GDP. Was it over 5%, remember rightly there? Are we going to a stage now whereby this protracted decline in Hong Kong economic activity is having or might well have an impact on sort of longer term investor behaviour there?
It is a risk, and as you referred to earlier, tensions between the US and China and the impact that has on global trade is going to very much impact Hong Kong's position, and obviously if the financial sector there takes a hit, then that will be really bad as well. So what Hong Kong, though, does have going for it at the moment is that it's actually weathering the virus reasonably well. They went pretty hard early in terms of, responding to the disease. And obviously they've got experience there of dealing with SARS previously. And so I think, the public there were on board pretty quickly. And, it's been quite successful in managing the actual disease, and then hopefully that will allow them to perhaps ease some of the restrictions and get business working a bit more quickly than in other parts of the world. So that's something that might help them going forward. But there's still definitely a lot of challenges with Hong Kong. You've just seen yesterday with their PMI, again very weak and showing a very strong contraction in April, and so it's going to be a long process to just get back to level terms.
Okay. Now,
Okay.
Yeah, sorry, Mark. Yeah.
Hi. This is Mark. We have Chinese merchandise trade coming up from. Is it going to be Thursday your time?
Yeah, later on. Yeah, just in a few hours' time. Yep.
And I'm just, I don't see any consensus for that. Is that something that the forecasters do, or is I can see contraction? It was moving in for a long period in contraction. Is there steeper contraction? And this is for April, right? So this is a pretty updated set of figures. How should we read those figures? Are they already going to be out of date because of the virus's effect in Europe and in North America?
Well, possibly, but we're going to see, I think, right across the region, obviously the impact of weaker global demand, and that just really, I think, puts the challenge on some of these Asian economies to try and find some more reliable sources of growth in the near time. So it might just have to, continue to rely on some fiscal stimulus to try and, kickstart these economies, given that they can't rely on external demand in the circumstances. And that's something that doesn't come naturally to them all the time. There is this definite reliance on external demand to drive growth. One probably main exception to that is India, where their economy is less exposed to global trade, but they're still feeling the impact just from the disease because of what they've done with their national lockdown. And we had a very striking number for the Indian services PMI yesterday. Fell to, let me just find it. Fell to
I think it's like 5. I'm looking it up now.
5.4. I mean, I think most of our listeners are familiar with PMI surveys and how the index works for those surveys. 50 is the no change level, and we nearly always operate in that sort of range between 45 and 55. 45 is a pretty weak number generally, but it's got down to 5.4, which is, I don't remember ever seeing a PMI number that low.
Oh, that means just about everybody who they're sampling are saying that business is down.
Yeah.
One exception to the rule I noted appear going back to your home part of the world, Brian, Australia. We saw nothing out the RBA, and they seemed, what little I saw about it, they weren't too sort of downbeat about the outlook. And then you had this huge surge in March retail sales. Was that just some form of panic buying, as we've seen of, well, at least essential items, certainly out of Europe anyway, or is it just the fact that consumption in Australia is holding up surprisingly well?
Well, I think that's a really good example to just highlight just how important it is to look behind the headline numbers now and really consider what's going on with these data. The economic impact of the crisis is showing up in the data, but that really means understanding how the data works is important to understanding how this crisis plays out. So sometimes you're going to see some numbers that look scary or a bit confusing, or you need to look a bit deeper behind the headline number to really work out what's going on. So that's definitely the case here. It was a pretty sharp increase in the headline number, but that was it was driven by food mainly. So we've seen in response to the pandemic, Australian households hitting the supermarkets pretty hard, stocking up the pantry, stocking up the fridge, and that's drove that headline number. If you look at some of the other components, though, very sharp declines. So, there's only so many, so many items that you can put in the pantry. So I think going forward, you will see that number come off a bit, and then perhaps some of the other components might start to bounce back a bit. But it's just going to really highlight the importance of analysing the numbers pretty carefully to see what's going on.
Are you guys seeing any shortages here in the U.S.? We're getting shortages in food. Wendy's, which is I don't know if you guys have Wendy's, but it's very popular. And they go into the commodity markets all at once, buying beef, and they're out of the they've been out of the markets, and they're actually scratching things off their menu, which has a it's something I've never seen before. Are you guys seeing anything that, or
it hasn't been too bad in terms of I think the food supply chain is still working pretty well here. Obviously, there's been shortages of particular products at supermarkets at times. But again, in the last few weeks, that's started to improve as well. Again, in Australia, I think the public health measures have had a pretty good impact, and they are now starting to talk about easing some of those restrictions here. But you mentioned the RBA earlier, and they are still predicting a very sharp contraction in the numbers for the first half of the year, whether it's employment, output, just generally across the board. We're going to see some pretty weak numbers, but they are hopeful, or perhaps is probably the best word. They're definitely not confident, but they're hopeful that we will see a recovery both in the global economy and the domestic economy in the second half of the year, assuming, of course, that public health authorities do get on top of the disease.
Yeah. Okay. Before we move across to Mark, just a quick one, and say in terms of central bank stuff, I mentioned the RBA. I just wanted to ask you about the RBNZ, the Kiwi central bank. A couple of weeks ago, there were some reports about the RBNZ governor apparently discussing the possibility of monetizing the debt. Is that something which is genuinely being contemplated, or just a kind of an airy-fairy idea which some reporter got hold of?
I think they would be reluctant to go down that path unless they really had to. Again, New Zealand is doing all right from a public health perspective, and hopefully they'll also see a bit of a recovery in their economic numbers towards the end of the year. They haven't been hit too hard so far, and so I think that sort of measure it's potentially on the table, but I wouldn't expect to see it unless things really stay bad for an extended period.
Yeah, certainly be interesting if they did go down that route. Okay, thanks for that, Brian. Right then, Mr. Pender. Well, I guess if anything's going to tell us what's happening to the US economy at the moment, it's going to be Friday's employment report. So come on then, just how grim is it going to be?
Well, before we even get to see how grim that is, we have to get through tomorrow's jobless claims. And I don't these peaked over nearly 7 million. It was the end of March, and they've been coming down. But now, Econoday's consensus is 3 million. So the trend, if you just look at the line, it's a favorable line. But the magnitude of these weekly totals is just how long? It's frightening. And the more these go, the deeper GDP will go. But ultimately, I guess your ultimate measure, historical measure of a country's troubles is the unemployment rate. And we'll get that out on Friday. We'll get a first look at it, I guess. And let's see what the Econoday, the latest thing, Econoday consensus on the unemployment rate. It was the mid-teens last I looked at. I'm just calling it up now. It was 16.4% is what we're expecting. And I think that's going to have to be going up as we speak, actually significantly so, because that's almost the low double digits is where the unemployment rate already is for the insured workers. And the headline payroll change looks to be 21.5 million jobs lost, which is no surprise because that's roughly what we've seen, low 20s, not quite mid 20s so far in claims over the last 6 weeks or so. So it's really those weekly initial claims are the ones that really signal the conditions here. And I just have a question for you guys. Did you see weekly unemployment claims, other data in other countries? Is this just a U.S. thing, or?
Well, certainly within Europe, we don't really get official weekly jobless numbers at all. So the early calls on the monthly numbers out of the UK and out of Europe will typically be based on what we hear from the likes of the PMI surveys and any other business surveys.
Yeah. Well, here they're very.
That's the same generally in the Asia Pacific region.
Well, this is a very valuable thing to do to have these weekly numbers, and really, so the Friday's employment report is really just going to be a shadow of the last period of these weekly claims. And the whole thing is, what's interesting here now is average hourly earnings. Our consensus here is still pretty routine, 0.3 on the month and 3.2 on the year percent. But the interesting thing is the outside range is very, very high, as much as 7.9% for the year-on-year change and 5% for the monthly change. And this reflects the suspicions among some forecasters that the job concentrations have been lost in lower wage work. And so when you remove them, the average goes up. But not all of them see that. We also have a minus 0.1% forecast, for instance, on the monthly change, looking at it in the other direction. But I guess that's a little bit of a side note. I don't think it'll have any impact on policy, or of course it wouldn't have anything on inflation. But deflation is a big deal. I mean, right now, is how deflationary is this whole virus going to prove? There are certainly some isolated increases in food, for instance, but generally, and especially with oil so low, fuel so low, this is very frustrating because we've been through 10 years, a whole cycle of stubbornly disinflationary trends, and now this is going to move perhaps significantly underwater. So, Jeremy, okay, so what do you? I'll hit it back to you. What do you think a deflation would mean for the financial markets? What would go up and what would go down?
Well, I think if we get deflation, the central banks have got real problems on their hands. As you mentioned, I think a lot of central banks with inflation targets now have been desperately trying to achieve those targets ever since the global financial crisis. I suppose, from my part of the world in Europe, if we look at the ECB, you talk about inflation. Well, the flash numbers we had, for April, they showed headline inflation year on year down to where just 0.4%. Now, they've been struggling to get to this 2% mark now for the best part of 3-4 years or so. If they were to see prices start going down, then I think we're talking about a fundamental overhaul of monetary policy. I think it's got to the stage, well, in fact, prior to the onset of this COVID-19 crisis, people may remember that the ECB announced that it would be undertaking a complete structural review of what it wants to do with ECB policy, what it should be looking at, how it should get there, and everything else. Then we get the coronavirus crisis, and all of a sudden, you just start throwing the kitchen sink to try and get the economy moving again and to make sure we have a continued stable flow of liquidity through financial markets. If we get prices starting to go down, then I think it really is. I mentioned to ask Brian about, do they start monetizing the debt? Well, they're going to have to do something which will stop prices spiraling downwards. And to do that, you have to do something which will ultimately provide a big boost to aggregate demand. And that will require, I suspect, a further blowout in fiscal deficits, because effectively we're talking about declining consumer demand. So the hole in private sector demand has got to be more than filled by public sector demand, which effectively means borrowing. They've got to finance that borrowing. They can't afford to finance it through raising interest rate to make bonds attractive. So basically, it's going to be down to central banks to effectively, we said, monetize the debt and actually just start, funding direct spending by governments wherever it may be. So I think it would be a huge move.
That's the Reich Bank in the early 20s in the Weimar Republic.
It is.
And then, of course, in Asia, we've had, the Bank of Japan just be in a complete lockdown, trying to deal with its deflation for many years, and it's had a huge impact on the monetary policy that they're able to do, and just the effectiveness of it.
Yeah, I'm going to say, there's got to be. I think we've had these podcasts, in I don't know, going back a few years now. We've talked about, one of the fundamental problems confronting policymakers, particularly central bankers, was that if they were to be hit by some kind of big crisis now, and this is going back a few years, post the global financial downturn, interest rates for a lot of countries had hardly crept above zero in the first place. So they got so little ammunition left, and that now really is just being proven. just look at my world. I'm saying with the ECB last week, and I think they can be regarded amongst the major central banks as probably still lagging somewhat behind. When we think what the Fed's done with its balance sheet, it's going through the roof. The ECB, by comparison, is hardly doing anything. But what they did do last week, when, to be honest, they didn't do much because they didn't change interest rates, they didn't announce any change to their asset purchase program. What they did do was to introduce some of these so-called additional long-term repo operations, under which now they can effectively lend to the banks at -1%, so long as the banks, lenders of the ECB wants them to. So we're already effectively in a negative interest rate environment as far as ECB interest rates are concerned anyway. And again, well, if you're already negative, then what's the point of making it even more negative? How's that going to help to stimulate demand? So yes, I think it's a real big problem for central bankers at the moment. And personally speaking, I really do think if this situation continues, then what can you do to get growth going again? And it's, of course, doubly difficult this time because of the nature of the downturn in the economy. Throwing a lot of money at the economy doesn't necessarily mean that the coronavirus is going to end in a hurry. That's probably got nothing to do with it. So it's going to be, I suppose, bottom line, you asked me, going back to your original question, what moves? Well, it just suggests I think things are going to remain very volatile for some considerable while yet.
Good news. Is there any good news? Anybody have any good news?
Well, I was going to mention, just to summarise the European economy, that if you look at Spain, their new car registrations in April were down 97%. And that was also true of the United Kingdom as well, which, now going back to Brian talking about, was it a seven index on the Indian services PMI? Well, it is. Effectively, it means that part of the economy simply doesn't work anymore. There weren't any cars being sold. The sector just simply ground to a halt.
And it's both on the demand and the supply side.
Well, the hope, I suppose,
production is shut down and buying is shut down.
And the hope has got to be that consumers will start buying again as they start to loosen some of these restrictions. But it's it's really problematic. I mentioned take about your Mark, your first quarter US GDP quarter on quarter. Do you remember the rate off the top of your head? Either annualized or quarter on quarter.
4.7. That's a guess. I'd have to call it back up. It wasn't too bad. It was
just over 5.
It was lumped up.
Just over 5% annualized. Yeah.
Yeah, but that was all because of March. It was just 2 weeks in March.
Yeah, sure. Yeah, sure. But what I was going to say was, you take the Eurozone. First quarter Eurozone GDP, if you analyse the decline there, it was down about 15%, so 15%, and exactly the same as your side. That's with the lockdown only starting in the middle of March. So, effectively, once we get into April and May and perhaps June, then that's when the lockdown's really taking effect. So the second quarter numbers on paper are going to look absolutely horrible. Good news. Well, I haven't got any, but what I will say, just to stir the pot a bit more, since I think it's worth mentioning, is regards to some potential problems for ECB policy, and this comes out the German's Constitutional Court, which, as of yesterday, said that the ECB's asset purchase program, so effectively their QE, their bond buying program, their purchases aren't backed by European treaties. And it's come out and told the Bundesbank not to participate in this program and to sell its already substantial holdings of paper if the ECB fails to satisfy its demands for what it calls an explanation as to how purchases are proportional. Now, it's given the ECB 3 months effectively to come out and explain why it's doing what it's doing with its asset purchase program. And if it's not happy with it, then under German law, it could actually inform the Bundesbank, right, you're no longer taking part in the ECB's bond buying program. And since the Bundesbank is the most important of the central banks, this would have huge implications as far as the whole program itself is concerned. And also, for those countries which are currently really dependent upon the ECB's buying, so the peripheral EMU countries like Spain and in particular Italy, it could be absolute disaster. So, I mean, to be honest, I can't believe this thing will actually happen. But were it to happen, it would be a huge blow to the whole Eurozone per se. And it's the kind of thing which ultimately could just lead the thing to fall apart. So there's, as well as all the coronavirus and the terrible economic news going on, there's some nasty politics taking place at the moment, which, for the investor community, which really doesn't know what it's supposed to be doing, makes it just about as bad as it can get. So,
well, on that note,
sorry, that's what you're saying. Right, what else can I just quickly mention, finish off from the European side? Bank of England, if anyone's interested in it, probably not. They come out tomorrow. I mentioned them more, not so much because they're expected to do anything, because they did actually do quite a lot in terms of their policy changes in March time. But tomorrow they will be releasing their statement 5 hours earlier. So that will be at 7 o'clock in the morning, London time, as opposed to the usual midday. And that's because they want to try and tie in their own report with a report from the Financial Policy Committee, which is looking at some of the financial implications of the coronavirus. So no immediate implications for how the COVID is affecting the B of E per se, but it is, at least for this particular month anyway, an earlier change. I'm saying nothing's actually expected out of the Bank of England tomorrow because they have done quite a lot, but it's got to be said, because these numbers are coming in as bad as they are, and I suspect that, like most people, the central banks have been caught by surprise at just how poor they are. There's got to be at least some chance that they could raise their quantitative easing ceiling. That currently stands at 645 billion sterling, and it's certainly not impossible that they could raise that a little bit further. Right, well, that's probably it from my side. Has anybody else got anything to say? We should, on a bright note, so we can end this thing.
Well, I mean, over in the Asia Pacific region, there are some signs of improvement in countries like Hong Kong, Australia,
Good man, go for
New
it.
Zealand. But we don't want to claim that we're out of the woods yet, and obviously this thing is unpredictable. But policymakers here are have as a baseline scenario, very weak first half of the year, but improvement in the second half of the year. So we'll just cross our fingers and hope.
All right. And on the final, Mark, have you finished? Anything else you want to say?
I'm out of bad news. So
in that case, you probably are done. Well, I guess if we do want to finish it on a bright note, and I'm taking a punt here. Brian, so you talked about all this precautionary buying, panic buying, and stuff of groceries and everything else. Is your fridge full of tinnies now?
There is enough to keep me under control. Yes, no problem.
That's excellent. That's, I think, is what we can call a good bit of news to end on. So that is it for today then. Apparently, this was our 201st podcast. So to anyone who's come anywhere close to listening to all of them, your stamina must surely be more than enough to beat this COVID-19 lock. And to everyone, on behalf of Mark, Brian and myself, thanks as always for tuning in. We'll be back next week, so do join us then. And in the interim, remember to keep up to date with all the key data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.